Hi, today I'm going to be doing the Finance 3000 midterm number 2. Just warning, I'm not a teacher, I'm not a tutor or anything. I'm just a student just like you, and I'm going to show you how I did it to find my answers. So, let's get started. So number 1 asks, which one has the highest current yield? What that is essentially asking is annual coupon over the bond price. And this is the present value, and this is the annual coupon amount that they're asking for. Now, to get this, what we have to do is do each of these individually. So A, the annual coupon amount would be 0.085 times the face value, which is $1,000, over the bond price, or the present value. The present value is $1,100 as it is listed right here. And when you calculate that, that comes out to 7.73%. Now, for B, this is going to require a little bit more work. So let's do the third one first. The third one is similar to the first one in that the coupon rate is given. So 0.06 times the face value, or the par value, $1,000, over the present value, or the bond price, which is $540. When you calculate that, that comes out to 11.11%. Now, to look for the fourth one, this is a zero coupon. So the coupon value is $0. You can find the present value, which is $250, but anything divided by 0 is just 0. So we can count that out, equals 0. Now, to find B, the more complicated one we talked about before, we're given the coupon amount. It's $45 for every 6 months. So what that means is it is a $90 amount, $90 coupon for an entire year. Now, the thing we're trying to look for is the bond price, or the present value. Now, this is a little bit more complicated. So with the information that we're given, let's find that. So N would be 20 because every 6 months, and it's a 10-year period, so there's 20 payments. Interest would be 3%. It's not 6%. 6% is the annual interest. We're looking for the semi-annual, or the every payment interest. What we're looking for is the present value, right? And we have the payment of $45 per session. And the future value is $1,000. Now, to find the present value, we plug all of this into a financial calculator. Make sure you clear everything first. Okay. The N is 20, so 20N, interest, payment, and the future value. Now, to find the present value, you hit compute and you hit PV. Then you get 1,223.16. That is your present value. Now put that as the denominator, 1,223.16. When you do the math and divide that, you get 7.36%. Now, of these answers that we just found, which is the highest current yield? So which is the highest percentage? It's C. So C is our answer. Now for the next one, yield to maturity. This simply is asking for what is the interest, or the YTM. So this one, we have to write out all the details. For the first one, it's N. Let's write this out first, step by step. N, interest, present value, payment, and the future value. Now, For the first one, N is 20. The interest is what we're looking for. The present value is $1,100, and the payment is 0.085, which is the coupon rate, times the face value. Now the future value is $1,000. Interest then is 1,100. Oh, I forgot to tell you, you always put a negative in front of that. The payment is 0.085 times 1,000, which is the payment, and the future value is 1,000. Now compute interest, and you get 7.5178. So we can just round that to 7.52. Next, to get B, we actually don't have to do the entire problem. The interest rate is already given to us. It's 6% here. Now to get the third interest rate, we do the same thing we did with the first one. So N is 18 years. Interest is what we're looking for. Present value is $540, negative in front of it. The payment is 0.06 times 1,000. And the future value is $1,000. The future value is the face value. So to get the interest of that, we plug that into the calculator again. 18, 540 negative is the present value. 0.06 times 1,000 is the payment, and the future value is 1,000. Now compute interest, and we get 12.5553. Now for D, we also have to find this interest. So N is 30 years. Interest is what we're looking for. The present value is 250. Put the negative in front of it. The payment is 0 because it is a 0 coupon bond, and the future value is 1,000. So the interest then comes out to $4.73%. So obviously, of these 4 different options, the highest percentage, the highest interest rate, the highest yield to maturity would be the third one. So C is our answer. Okay, so which one is traded at the largest premium? What this is essentially asking is, what's the present value? Now, luckily, in question 2, we already found the present values of A, C, and D. So of A, it's 1,100. For C, the present value was 540. For D, the present value is 250. Now for B, we found the present value in question 1 already. So if you look back, we were looking for the present value. What we calculated was that the present value is 1,223.16. So of these 4 options, which has the highest present value or the largest premium? In this case, it's B. 5. A 6% coupon rate. Coupons paid annually. $1,000 par value with 5 years left until maturity is currently worth $883.31. So all the information, and it's asking for what is the YTM. So all the information here is given already. This is the coupon rate. This is the face value, this is the years, and it's because it's annually, this is the years, and this is the present value. So let's write that out first. N, IY, PV, payment, and the future value. Because it's annual payments, it's five different payments you're receiving. The interest is what we're looking for. So remember in question 2, I told you, YTM and interest, they're basically interchangeable. Present value is negative 883.31 given here. The payment is 6% times the face value, so 0.06 times 1,000, and the future value is $1,000. That is the face value of the bond. Now, to get this, we just plug this into the financial calculator again. So 5 is N, present value is 883.31 negative. The payment is 0.06 times 1,000. That's the payment. The future value is 1,000. And now compute interest. The interest is 9%. C. Okay. For question 6, a 6% coupon rate paid annually, $1,000 par value with 5 years left until maturity is currently worth 883.31. How much will it be worth 2 years from now if the interest rates are constant and hence its YTM does not change? Okay, so if this is 2 years, if this is an interest rate that is constant and it's the same numbers as number 5, we already know that our interest is 9%. So that's very important information. So let's just write that down first, 9%. And of course we write the other information as well. And now to find this, they talk about it having 2 years from now. So if the bond is with 5 years left and it's 2 years from now, the payment periods is 3. We're looking for the present value, and the payment is 0.06, which is the coupon rate, times 1,000, and the future value is $1,000, which is the face value of the product. Because it's asking for how much will it be worth 2 years from now, we're looking for that present value. That's not the future value. That's the present value in 2 years from now. So N is 3, interest is 9%, payment is 0.06 times 1,000, and the future value is compute present value, and you get a PV of 924.06. So, yep, the answer is B. Now for number 7, what is the coupon rate for a bond with 6 years until maturity, a price of $1,253.78, and a yield to maturity of 5%? Interest is paid annually. Par value is $1,000. So it's asking for the coupon rate and not the coupon payment. So one thing you want to know is that you want to remember is that the coupon payment is the coupon rate times the face value. So essentially, we're looking for the payment of these options. So let's just find that out first. Again, we note all these information down. The payment is what we're looking for, right? So N is 6, interest is the 5%, The present value is 1,253.78, and the future value is $1,000. So let's get the payment, which would then be put a negative on that. Almost forgot to do that. That's the future value, and we get a payment of 90. We can just round that to $100. So the payment is $100. And like I said before, the payment is essentially the coupon rate times the par value. Now, if you just reverse that, what the coupon rate is simply the payment over the face value. The information we have is 100, which is the payment, and the face value, which was given in the problem, which is $1,000. So what that comes out to is obviously 10%. Answer C. Okay, so for number 8, the question is, consider a bond with 4 years until maturity, a par value of $1,000, and a coupon paid annually. If the YTM of the bond increases from 9% to 11%, then what will happen? Okay, so we can go back to the concepts to eliminate some of the choices. First of all, we know that the interest rate goes up from 9% to 11%. When the interest rates goes up, the prices go down. So the bond price will not increase. So we can just take out those options first. Now we're left with the options of the bond price decreasing by $62, and is the yield larger than 9% or lower than 9%? Well, the information in the question says that it goes from 9 to 11, so therefore it's larger rather than lower than 9%. Answer is B. All right, number 10. Which one of these statements are false? So they're asking about yield curves. If you remember, or you can look up what yield curves are, they're essentially these charts that show the years to maturity and the percentage of the year to maturity, and this is the years, and the majority of them are an upward sloping type curve. So what this is asking is, the yield curve depicts the current relationship between bond yields and default risk. Well, it talks about the yield to maturity, but it doesn't talk about the default risk. This years is not the default risk, so this is false. The second one, the yield curve depicts the default. Like we said, it's not about the default risk. And the third one, the most common shape for the yield curve is downward sloping. This is not downward sloping. This is progressively increasing as the years increase. So this is also false, which is how we get our answer D. Now for 11, if an investor purchases a 3% 5-year Treasury inflation protected security at its par value of $1,000, and the CPI increases 4% over each of the next 5 years, what will be the real return for the investors holding the bond until its maturity? Well, if you look back at the slides, one of the things that is said is that the real return is equal to the coupon rate. Essentially, that's the entire question. I mean, if the investor purchases a 3% and that's the coupon rate, then the answer is 3%. I'm sorry if I don't go into more detail. This is just how I solved it and how I came to the conclusion. If you know a better way, please comment below. Number 12 asks for the information we're given in number 12 is that there's a 4% coupon rate and there's $1,000 face value. So what we should do first is that the 0.04, which is the coupon rate, times the face value is $40. So in the next 2 years, this $40 increases by 5%. So what we can do is times 1.05 because it increases 5%, and after the first year we get this, $42. Now after the second year, what we get is times another 5%, which is $44.1. So over here we can eliminate A and D as the coupon payments are $44.1 per year. Now to find the par value of the bond, the original par value of the bond is $1,000. But because the CPI increases by 5% each year, what we can do is 1,000 times 1.05 and then times another 1.05 for the second year. And as a result, we get $1,102.5. Answer is B. Now, for number 13, which of the following is more likely to be correct if the market value of equity is less than the book value of equity? Now, just think about that for a second. If the market value is less than the book value, so after thinking about it, the market value is less than the book value. What this means is that to outsiders, the value is decreasing. It's not doing so well. So what this means is investors anticipate a low earning potential. Will the company go bankrupt? No, because the book value is still okay. Investors anticipate an excellent earning potential. No, this is if it was the opposite, then they would be expecting an excellent earning potential. So it's not C. And D, assets have been fully depreciated. No, it doesn't say anything about the assets being fully depreciated. So therefore, our answer is A. Investors anticipate a low earning potential. Now, to calculate, so for 14, calculate the earnings before interest and tax for a firm with $3 million total revenue, $1.5 million cost of goods sold, and $300,000 depreciation expense, $100,000 interest expense, and paying $200,000 in dividends to shareholders. The key is knowing what EBIT means, earnings before interest and tax. So which one of these are interest? We can just eliminate out this first. And we know, because we researched the EBIT, that EBIT does not include dividends. It does not include dividends. So we can also eliminate this as well. So what we're left with is the 3 mil in total revenue minus the cost of goods sold, and the depreciation, which is 300,000. Don't get that messed up. So as a result, we get 3 million minus 1.5 million minus 300,000, and we get 1,200,000. Answer is B. Now, for 15, a firm has 120,000 shares of stock outstanding, a sustainable growth rate of 3.8%, and a 648,200 in next year's free cash flow. What value would you place on a share of this firm's stock if you require a 14% rate of return? So, with this question, we're asking what is the stock price share of this firm's stock. That's essentially asking stock price. Now, the stock price formula is this. Free cash flow. This is just something you're going to have to memorize. Over the required rate of return, which we're given, the 14%, and the growth rate. And all of this is over, this is in parentheses, over the number of shares. So let's use the information we're given in the problem. The free cash flow is $648,200 next year free cash flow. So write that down as the numerator. The required rate of return is 14%. So it's written here. So we write 0.14 minus the growth rate. The growth rate is given here, a sustainable rate of growth at 3.8%. So this is 0.038. And all of this is over the number of shares, which is 120,000 shares. So if you plug all of this into so for organizational sake, we'll do the denominator first. 0.14 minus 0.038 is 0.1020 over 648,200. So let's write that out. 648,200 divided by 0.1020. And you get this number. And you remember you have to divide it by the number of total shares. So divided by 120,000 shares, and your answer comes out to $52.96. We can round that up. And yeah, that's what the stock price would be. So, like I said, you're just gonna have to remember the stock price formula. So just review that a couple times before you take the exam. Now, for number 16, what we have is, what is the current price of a share of stock for a firm with $5 million in balance sheet equity and 500,000 shares of outstanding stock, and a price/book ratio of $4. So what this question is asking is, what is the current price of a share of stock given this information? So what we have to do is the equity over the number of shares. And 5 million is in the balance sheet, so that's the numerator. Over the number of shares is 500,000. So as a result, that comes out to $10. Because the price and book ratio is 4, what we have to do is take this $10 times the 4, which is what people will actually pay, and the result is $40. And that's the current price of a share of stock for this firm. For number 17, how is it possible for real rates of return to increase during times when the rate of inflation increases? Well, just because inflation increases does not mean that the nominal returns decrease. What it actually means could be, so if we want a way that's possible for the real rates of return to increase, the nominal returns have to increase faster and more than inflation hurts them. So essentially, what that is that's the final question on this Finance 3000 midterm number 2 review. I just want to reiterate, I'm not a teacher, I'm not a tutor, I'm not an expert in this class. by any means. This is just how I did it, and I thought it would be really useful if there was a way to look back at it, or for future students to take a look at the process of how a student does it. I'm not saying this is like the most educationally well planned out way to do it, so take it for what it is. This is what I just did, so if you want to screenshot it, here's your opportunity. Also, things I would recommend that you write down and remember are these: current yield formula, yield to maturity, coupon rate, real return, and stock price formula. Try to memorize those, and good luck on your exams.